Hi, I'm Cory Litzenberger from CGLTax.ca, and this is Brainstorming Plus Tax. On this episode of Brainstorming Plus Tax, we're going to take a mid-year look at your current tax position. Now, most Canadians have now filed their individual tax return for last year, and they've received a notice of assessment outlining their tax position for that year. Those who receive a refund will celebrate that fact, or, less happily, those who receive the tax bill will have to pay the tax amount owed. Now, both groups of taxpayers are then likely to forget about taxes until it's tax filing season again next spring. The fact is, however, that mid-year is a very good time to assess one's tax position for the current year, and is a particularly good idea for taxpayers who have received a large refund or a large bill for tax owing. Although few Canadians have this perspective, the reality is that getting either a big tax refund or having to pay a large tax bill is a sign that one's tax affairs need attention. A refund, especially a large one, means that the taxpayer has overpaid his or her taxes for the previous year, and essentially has provided the Canada Revenue Agency, or CRA, with an interest-free loan of funds that could have been put to better use in the taxpayer's hands. The other outcome, a large bill, means that taxes have been underpaid for the previous year, and could mean paying interest charges to the CRA. Either way, it's in the taxpayer's best interest to ensure that tax paid throughout a year is sufficient to cover his or her taxes without overpaying or underpaying. The best case scenario is to complete one's tax return and then receive a notice of assessment, which indicates that there is neither a refund payable or no amount owing. All of this makes the midpoint of the tax year a good time to make sure that everything is on track and put in place any adjustments needed to help ensure that there are no tax surprises when you file your return next year. And as the calendar year goes on, the opportunities to make a significant difference to one's current year tax situation diminish. The first step in doing that review is to get a sense of how much tax one will have to pay for this year. The income of most taxpayers doesn't change significantly from year to year, and by mid-year, most taxpayers will have a good sense of what their income will be for the year. Consequently, where income hasn't changed much, the amount of tax that was paid last year that can be found on your return serves as a good starting point. There are two ways of paying taxes throughout the year. The majority of Canadians, including all employees, have income taxes deducted from their paychecks and remitted to the federal government on their behalf. These are known as source deductions. Taxpayers who do not have income tax deducted at source, which would include self-employed individuals and frequently retired taxpayers, make tax payments directly to the federal government 4 times a year, all by the 15th of March, June, September, and December, through the tax installment system. Once a rough idea of one's tax liability for this year is arrived at, it's necessary to figure out whether income tax payments made to date, either by source deductions or installments, match up with that tax liability figure, recognizing that by this point in the year, approximately 1/2 of this year's taxes should have already been paid. If they haven't, and particularly if there's a shortfall, which will mean a balance owing when the return for this year is filed next spring, the taxpayer will need to take steps to remedy that. Where the individual involved pays tax by installments, the solution is simple. He or she can simply increase or decrease the amount of remaining installment payments made in the current year, so that the total installment payments made over the course of the year accurately reflect the total tax payable for the year. The only caveat in that situation is that the individual should err on the side of caution to ensure that there isn't a shortfall in installment payments, which would result in interest charges levied by the CRA. The situation is a little more complex for employees or for anyone who has tax deducted at source. Often when such individuals discover that they are overpaying taxes through source deductions, it's because other deductions that they claim on their return for the year for expenditures like deductible support payments, childcare expenses, or contributions to an RRSP aren't taken into account in calculating the amount of tax they deduct at source. There is a solution for employees who find themselves in that situation, and it's a Form T1213 or 1213. This is called Request to Reduce Tax Deductions at Source. It's available on the CRA website, and on that form, the taxpayer identifies the additional amounts which will be deducted on the return for the year, and once the CRA verifies that those deductible expenditures are being made, it will authorize the taxpayer's employer to reduce the amount of tax which is being withheld at source, so as to reflect the reduced tax payable for the year by the employee taxpayer. Where it's the opposite situation and a taxpayer finds that source deductions being made will not be sufficient to cover his or her tax liability for the year, meaning they'll have a large tax bill to be paid next spring, the solution is to have those source deductions increased. To do that, the employee needs to obtain a TD1 form for their province of residence for this year, which is also available on the CRA website. On the reverse side of that Form TD1, there is a section entitled Additional Tax to be Deducted. in which the employee can direct his or her employer to deduct additional amounts at source for income tax. And they can specify the dollar amount which is to be deducted from each paycheck on a go-forward basis. Now, on a final note, no one likes getting a tax bill, and there are taxpayers who simply like getting a tax refund and overpay their taxes throughout the year to create that result. Some of those taxpayers view that approach as kind of a forced savings plan, while others simply like the idea of getting an annual check or direct deposit from the government. There's nothing wrong with that approach, so as long as the taxpayer understands that the tax refund is simply money that was always theirs, and is simply being returned to them by the CRA without interest. Those who would rather not loan money to the CRA interest-free and do not want to face a tax bill each spring can avoid both scenarios by investing a couple hours of time and a little paperwork to ensure that this year's tax payments are on track. And with that, for CGL Strategic Business and Tax Advisors, I'm Cory Litzenberger. Thanks for listening.